believe, Betsy, we sent out a draft one for everybody that you made.
We did.
Awesome.
And let me say, first of all, this is the second takeaway. First takeaway is this is not a DIY model. Do not do it yourself and hire someone. The second takeaway is craft an investment policy statement and then hold yourself to the investment policy statement parameters. So that's your second takeaway. So we sent out a thing yesterday and encouraged people to print this off. If you haven't done it, we're going to share it here on the screen. It's the same. The purpose and scope it follows the pieces within the PowerPoint. And by the way, we will post the PowerPoint and other documents to our website. So feel free to, if you want to take it back and share it with your finance committee or somebody else. It's there. This is being recorded, and additionally, the full PowerPoint is will be put up on the website, so you could get that as you need it. And again, we're happy for you to take it and share it. This document is a draft investment policy statement for your administrative reserve. We put ABC Charity. You could easily put, I see Tom Mulholland, the Washington County Historical Society, the Domestic Violence Services, whomever else is on the call. Feel free to just, take whatever here makes sense for you. I can tell you that it follows roughly the investment policy that the Community Foundation uses. It's more basic because we're a little more complicated because of our size, but the basic components are the same. So the first thing you want to do, you want to define the purpose and scope of the policy statement. Who's responsible? Your board of directors, no doubt about that. Here we bring in the line of credit. If you have a line of credit, I would put it into this statement so that the administrative reserve and the line of credit, they should work in tandem. If you have a line of credit and is appropriately managed, it will enable you to keep your administrative reserve fully invested. Without the line of credit or some other access to ready cash, you are probably not going to be able to keep your administrative reserve fully invested. If you don't have a line of credit, my advice is to seek first, is there some way you can get some type of a line of credit? Just try it. I mean, I know some of you don't have it and you easily could do it because of the buildings that you own free and clear. So that would be my first, my advice to you is get your line of credit first, and then let's go ahead and work on this. So this statement is mentioned several times throughout the document. In the second paragraph, the board will follow an investment policy that seeks to achieve a reasonable long-term total return. That's an important concept. Total return, which means capital gains, realized and unrealized, dividend and interest income, the whole kit and caboodle. That's the long-term return. Consistent with acceptable investment risk, and we'll talk about that later as we go down through. So the second component of your investment policy statement, roles and responsibilities. At the Community Foundation, we have a separate investment committee that's responsible for our investment. Joe chairs that currently. We have a finance and audit committee as well. You may not be large enough to have both. You may just have a finance committee, and your finance committee would then be responsible for the investment. Whatever works for you. And I realize that many of you are small, and so you're not going to have, don't have that many people to do that type of a thing. But some committee has to be charged with that responsibility. And then of course it says in there that they're going to not utilize a DIY methodology, but they are actually going to contract with investment professionals to hold the assets and to invest the assets. So in every investment policy, you should have what's called the spending policy, the spending expectation, what you expect to pull off from the fund. We use the 6%. That's pretty common within the industry. Although I would say that I added a statement, although it's anticipated that in most years, no distribution will be taken, because this is an administrative reserve. This is not an administrative endowment. So the reserve should just be the reserve, and whatever monies it raises, it earns, should just go in there to continue to grow the reserve rather than spinning money off. That's the way I would handle it. And then, of course, you have to have, and you need your investment manager to understand that there may come a time, let's say, we have another state budget impasse for those of you who get big government grants, and we get no money. You expect to provide a service, but you get no money, and you're going to have to pull money down from your administrative reserve. That could happen. So you have to have, the investment manager has to understand that you may have to pull out, quote unquote, principal from the investment. Or let's say, heaven forbid, we got a pandemic. And all of your fundraising events have just been canceled because nobody can meet in person. You need that money. And so while you set the 6% as the spending policy, you really don't expect to spin that off into your operations. But again, you may at some point have to take a huge chunk out, at least in the short run, to cover those unexpected losses of revenue or unexpected increases in expense. So and you always do your investment goals and objective. And again, we talk about total return, moderate risk. Those are standards within the industry. Asset allocation policies and guidelines. So there are 3 columns: min, max, and then of course the target of your policy. I would say start with 65-35. And then go down from there. Don't go that 80-20. I mean, that's not, nobody here should be 80-20, but 65-35, some of you maybe. Some of you may be 50-50 because maybe you don't have a line of credit. Maybe your board doesn't want to take that much risk. I mean, you have to have this conversation. Joe, would you explain the target thing there? Would you do that, please?
Yeah, so if we think of this, part of us quantifying risk and keeping track of it is setting these goals and all that for our varying asset classes. So every time our investment advisors come in to present to us at the Community Foundation, they say, hey, here is where all of our current holdings are. Are they within variance? Are they within these ranges that we have all agreed to are appropriate based on our return need, our risk tolerance, and all these fun things that the professional should be helping your organization walk through? And something to point out, Betsy, I think is part of our job is quantifying these risks, right? When we say risk or downside, or when the market goes into a contraction or a recession, you should have some expectation of how bad would it get? How much do we track with these varying indices? So we have some expectation of when the water gets choppy, how bad should the boat, move up and down? But does that explain how we do the minimum, maximum, and the target? And then let's say that, I don't know, Betsy, maybe the large cap companies in the US did really well this quarter, and now that percentage is higher just because it grew. Well, the asset manager's job is to keep you within variance and rebalance that portfolio to make sure that you're within this variance that your board all agreed to stay within. And that's part of our job as well, whatever role I'm wearing at that time. If you're managing the assets, that's your job, is to keep them within their variances. So right. Did I give you the answer you were looking for?
Yeah. So if you look at the target, that target is a 65-35. So if you add up US equities at 57 and the international equities at 8, that's 65, and then 35 for the fixed income. But not just 65 of any equity. You're going to take 37% large cap, 10% mid cap. So you want to diversify within the equity component as well. So this is what's known as a well-diversified portfolio, and that's what you want. And go to the next page, Alicia. So a lot of stuff there. I don't know.
I can take that part real quick. One of the things,
Okay.
one of the parts that we want to have in our investment policy statements are asset definitions. So we are talking about some very large terms, right? When I say large cap companies, it's important for us to go in our investment policy statement and specifically state what quantifies or qualifies in that. And they're normally general definitions, but it becomes more important when it comes to our bonds. And you can, if you're reading through this, you can see in the description of our fixed income, or the example on this, we talk about credit quality, right? So Betsy, if I were somebody that was going to buy a piece of that, maybe I should ask Chris Claspy because he's our banker here. There's different ranges of debt quality out there. And when we're making those investments, we can limit how poor the quality is that we would be willing to buy. And that's very important within these. So when you set these parameters within your investment policy statement, you can say, hey, I don't want any junk bonds, or we don't want something in this level of risk. That might be great that the return is higher. We're not interested in that. And this helps you keep everything organized. So as you're holding your investment managers to task, you've documented, and your board can say, well, this is what we agreed to. And I think it's very important and prudent to make sure you do that, so you're not taking on an adverse risk of your organization, whether it be in a certain asset class or even just the type of assets you're buying within that class. I think that's how we talk about that. Yeah.
Yeah. So moving on to the rebalancing method and frequency, and we've already talked about that. You want, like, there are two general methods. Your manager, I've seen it where it's automatically rebalanced by computer, particularly if there's a lot of ETFs in there, just automatically will rebalance. And sometimes the manager will physically go in and buy and sell to rebalance you. And both are acceptable. Just make sure that they're doing it at least annually. By the way, this investment policy statement becomes part of your contract, so to speak, with your investment manager, so that everybody understands what's expected of everybody else. So once you develop your investment policy statement, then you're equipped then to go and start talking to some potential managers about providing services. Everyone's going to get the same document and understand it's the same, this is what we expect of you. So it's the basis of your contract with them. I mean, they'll have some other contract for sure, but your investment policy statement is your statement, and they should be able to, they'll try to give you their own statement. Use your statement. They want you to use the statement that their company provides, and insist that they use the statement that your board has approved. Okay, so then we talked about gift acceptance again. This is not typical in an investment policy statement, but because I know many of you are not currently accepting stock, and this would be the best way for you to get that capability is through that manager. I'm going to go down a little bit more, and then just the day that the thing has been adopted by the board. So you can go back to the regular slide then, Alicia.
Thanks for putting that together, Betsy. I think that's a great place to start for everybody. But remember, these policy statements should be crafted to your organization. So Betsy, thank you for putting all that together. And I know you put a lot of intellect into building that for everybody in the community. So
no
that's
problem.
very nice.
We're going to go to the next slide, the final slide. So we're talking a little bit about timing. Joe, you want to talk about the time?
Yeah, so I think that it's important. It's important to talk about this, where timing is very important when it comes to these investments. So I know that we've been talking about administrative reserves and having this cash and getting it to work and all that. But one of the last things I wanted to speak on is just how you, as an organization, time putting assets into the varying markets. So the most common way that most of us probably know about from our working lives are dollar cost averaging, right? And think of it, when you go to the store every week, you're eventually going to average your price for that good out over time, because sometimes you buy that good and it's a little higher, and sometimes it's a little bit lower. Hopefully everything's kind of been higher recently, but with dollar cost averaging, your organization may choose to put smaller increments of money into the market over time, and that would help even out your price that you pay. Sometimes the market will be up, sometimes it may be down, but that helps you mitigate that risk over time by slowly putting assets in over time. Now, preferably, the main rule in investing is buy low and sell high, but we don't always know when the stock market or bond market is at a low point, when, well, they call it catching a falling knife, right? We just don't know when. So being cognizant of the where the markets are at in their different cycles could give your organization an opportunity to purchase more securities. Say you're trying to implement X dollars over the next X years. Knowing where the markets are at in their varying cycles may show you that, hey, this is an opportune time because of a contraction, pullback, et cetera. And as we mentioned, we're moving into a more than likely a tighter Fed policy time. Interest rates will more than likely be coming up from what we're seeing the Fed say. So we might get some volatility that would allow you to either plan out a dollar cost averaging strategy or try to choose to implement larger chunks at lower times in the market if that's appropriate for your board. Regardless of which tactic you take an implementation, the one thing I would say is just timing is important, right? So when your organization takes all the time to set all this stuff up and do it right and get it documented and have all your ducks in a row, just be realistic with how you implement the cash and, don't rush. These things take time for a reason, and just make sure that everybody's comfortable as you move forward with it, and it'll all work out a lot better in the end, I promise.
Yeah, I know a lot of people were, if you watch the market, you say, well, January, we did not have a good January at the Community Foundation, I can tell you. And February is not looking so good either. So you say, why in the world, why would you put in mind the market is falling? I mean, to me, that's an opportunity. I'm going to transfer as much cash as I can into the market when it's low. I'm going to buy low. It's also called buying the dip, so that when it goes down, you buy low with the expectation it's going to go back up. But there's a general thing about, oh, you can't time the market. Well, in some ways you should. You don't want to, when it was at an all-time high, a stock, you don't want to buy at all-time high. But if you have a good investment manager, they will be able to find there are still, even when the stock market is high, there are still values. There's still value stocks to be found. It is, just takes a little bit longer to find them. So we have covered a boatload of information in about 45 minutes here. We wanted to take a little bit of time and open it up to question and answers for anything about what we talked today or anything relative to investment. We'd be happy to talk. Anybody have any questions?
Yeah, Betsy, I got a question for you. This is Dave Brem with the Bradford House.
Sure.
I understand that we've talked about we got to have cash to pay the day-to-day bills, and now we have this administrative reserve. What happens when you get to the next level, when somebody walks in the door and says, here's a $2 million check I want you to have? Where do you put that? Do we start then talking about an endowment reserve or an investment reserve that lays on top of the administrative reserve?
Well, first of all, congratulations.
We didn't get it yet.
That's a great gift. But yeah, you said in my way. So I would say that it's like everything else. You have to honor donor intent. So if the donor has a specific use for his very extraordinary gift, you have to honor that. And so it might be that he wants you to, make some immediate upgrades to your facility or hire new staff or whatever that might be. And you have to have that conversation. If he understands the value of providing for the future, and I were in that situation, I most certainly would be talking to that donor about using it to establish an administrative endowment. And Dave, I can talk to you later about that and what, you'll have to look at trust law and stuff like that. But, a gift of that magnitude would absolutely be a great administrative endowment. And then what happens then is that you invest it, and you will take the 5 or 6% every year, whatever your board determines, or sometimes the donor. Like we have a few administrative endowments, and the donors have determined the payout on that. So they can do that under trust law. So then you take that 5% each year into the operating account for the organization. But yeah, a gift of that magnitude, absolutely. I would at least talk to the donor about the administrative endowment. Any other questions? Any other comments?
For us here at the Community Foundation, what was helpful about this, and what can we build out in our future presentations, or what other things do you guys want to learn about in our local charity circles?
Whoop.
Well, Joe, I would say sort of the question I asked of Betsy is that this administrative reserve presentation was very helpful, but I'm thinking bigger terms, like what happens when we do get a large bequest from somebody. If we could have some conversation around that, on how does that get set up? Because I think it's a little more complicated than what we're talking about doing with the administrative reserve. So that would be a good thing in the future, maybe, to address that issue.
Yeah, I would say that, first things first, and we looked at the charities that we fund. Annually we fund about 150 nonprofits, and about 120 of them are 501c3 charities. We fund other nonprofits, but we looked at those and their balance sheets. They don't have endowments. Many of them don't even have reserves. So we really wanted to encourage people to work on, getting an administrative reserve together. And then, so this was, I know you participated last month, so this was just a follow-up to the administrative reserve thing. We will certainly have other trainings as time permits. One of the things I certainly want to talk about, because I know many of you have asked me about it, is different giving vehicles, stocks, IRA transfers, life insurance. Like we've done all that type of stuff, and we're going to do that probably not until the fourth quarter. But if you have a situation and you want to call me directly to talk about the administrative endowment, I'd be happy to talk to you now.
Okay.
Before that training, because I don't think the training is going to happen this year.
Okay.
Stuff that we have going on.
All right. Any other questions? Any other comments? Anything else to add? Cool. Well, thank you all very much for attending. We very much appreciate the Community Foundation, and Betsy and Alicia, thank you both for keeping the show running over there. The work that Betsy, you especially, and Alicia, you have been stepping in and doing. You guys are making a lot of good happen in this community, and so is everybody else on this call. I know most of the people on this call, and you guys are the core keeping this place moving forward. So thanks everybody for letting me run my mouth for once. I know I'm a lot when it comes to investments, but I really appreciate you guys listening.
All right, so I will we'll post this to our. It actually goes to the charity bulletin board, which is on our Day site. The training, the PowerPoint, this draft investment policy statement. And Joe, you have something on inflation, right? And we're gonna. So yeah, inflation's, we didn't talk about it today, but inflation is a real thing, and it should be part in some of the decisions that you make. So we'll post that to the charity bulletin board as well. I hope everyone has a safe trip home today. Maybe you're already home. I don't know. We'll see you next time. Thank you.